Hello friends, today we are going to discuss on one of the complex accounting standard, that is lease accounting, which is covered under IFRS 16 and IND AS 116. So the topics what we are going to discuss are understanding terms used in lease accounting, accounting in the books of leasing, accounting in the book of lessor, lease accounting in the books of manufacturer. So in part 1, we are going to cover the first two, understanding terms and accounting in the books of leasing. And in part 2, we'll talk about accounting in the book of lessor and accounting by manufacturer and dealers. So let's start with a question. How an organization procures assets? Okay. For example, if the company want to invest rupees 50 lakh rupees in buying plant and machinery, and that plant and machinery is having a life of 10 years. So there are two options in front of the company. One is buy the asset from the vendor and make the payment on payment terms. In this scenario, the asset will be capitalized. So asset account debited 50 lakhs to bank account. And second, the yearly depreciation will be depreciation account debited 5 lakh rupees to assets. Now there is another option where the company can take this asset on lease. In that scenario, the lease payment will be 5 lakh rupees per annum. Lease contract is for 10 years. And what is the accounting entry here? Rent account debited to 5 lakh to bank 5 lakh. So if you see in these two scenario, what's happening? The benefit is taken by the company. However, because in one case the ownership has been transferred, the company is accounting as an asset. In the second scenario, the asset is not capitalized because the ownership has not been transferred to the company. So in 2019, a new accounting standard was introduced, that is IFRS 16 IND AS 116, where it explains saying that asset has to be capitalized in the book of leasing. You can't be excused because the ownership has not been transferred. Okay. However, there are a few conditions which we will talk in the upcoming slides. But it is very clear that in lease accounting, the lessee has to capitalize even though the ownership has not been transferred to the lessee. So let's understand how the accounting is going to happen in the books of lessee. Before that, let's understand what is the definition of lease. So lease is a contract. That means we should have a written contract between the lessor and the lessee. What the contract should define, which conveys right to use an asset to lessee. That means the contract authorizes the lessee or empowers the lessee, gives a right to use the asset. For what? Agreed period of time. That means the contract should say for how many months, how many years the facility is given to the lessee in exchange of consideration. Definitely there should be consideration. Okay. The date on which a lessor makes an underlying asset available for use by a lessee is called a commencement date. So this date is going to be very important for us because all your accounting entries has to happen on commencement date, not from the date when the rent will be paid. Let's take an example. XYZ Limited has taken a machine on lease. Both parties entered into the agreement on 15th April 2022. And on the same date, machine was handed over to the lessee. But there is rent-free period of 6 months. It means rent will be paid by lessee only from 15th October 2022. So what is the commencement date? So in this case, it is the choice of XYZ Limited who is giving the machine on rent. And he has given a 6-month rent-free period. That means the lessee is not going to pay for the first 6 months. Okay. But the question here is that when should the accounting entry be posted in the book of leasing? So commencement date of the lease term is the date on which lease is entitled to exercise the right to use the lease assets. On this date, the entity recognizes the lease. So as we explained that commencement date is the date when the asset is ready to use or given by the lessor to the lessee. On that day, the entry has to be posted. So in this current scenario, 15th April is the date on which the lessee is going to account in their books. However, the accounting standard has stated very clearly that a lessee may elect not to apply this accounting standard if the term of the lease is very short, for example, like 10 months, 8 months. In that case, you need not apply this accounting standard. You need not account as per the requirement from the accounting standard. Similarly, if the lease contract is of a small value, that means nominal value, or not material to the company, then company can decide how to apply IND AS for those contracts. So let's try to understand what is the meaning of lease term under IND AS 116. So lease term is the non-cancelable period for which a lessee has the right to use an underlying asset. So generally, this non-cancelable period is called as lock-in period in the contract. That means at any cost, the lessee can't cancel the contract during this period. So in a contract, if you have 3 years lock-in period, that means the lessee is bound to pay 3 years rent to the lessor. However, there are two more items which can be added to the non-cancelable period to determine the lease period. What are those cases? One is renewal periods if it is reasonably certain to exercise. That means the management or the company has decided that they're going to renew the contract for a few more years. In that scenario, in addition to the lock-in period, the extension or the number of years which the company is planning to renew, that has to be added to the non-cancelable period. Second point, cancelable period. So if the company feel that they're still continuing beyond the non-cancelable period and they're going to continue for a few more years as per the contract, in that case, the cancelable period also will be added to the lease term. One should consider all relevant facts and circumstances that create an economic incentive for the lessee to exercise the option to extend the lease or not to exercise the option to terminate the lease. So always you have to evaluate that there is a economic benefit by extending the contract. Let's take an example. A company has taken a building on 5 years lease. As per the agreement, first 3 years are not cancelable. During the cancelable period, leasee can terminate by giving prior notice of 3 months. Lease rents are as follows. So what are the lease rent? 1 to 3 years, it is 3 lakh rupees per annum. 4 and 5th year, the last year, it is 2 lakh 50,000 per annum. In that city, rents are expected to grow every year by 5%. The rent in 4th and 5th year is below the market rates. What is the lease term here? Okay. So in this particular issue or in particular case, if you see, the contract is for 5 years, 3 years is non-cancelable, and 2 years is cancelable. So non-cancelable by default is considered for lease accounting. But here, if you see, 4th and 5th year, the rent is lower compared to the market. So it is very clear that management will take a decision to continue during 4th and 5th year as well, because in the market, the cost is more higher. So in this situation, 5 years will be considered for lease accounting. So let's try to understand how do we identify a lease in the contract. That is more important. Before we start doing the lease accounting, we need to see that whether the contract does have a lease contract or a sell contract. So the first question what we should ask is that is there an identified asset? This is more important because we should have an asset which is moving from the lessor to the lessee. If the answer is yes, the next question is very important. Does the customer have the right to obtain substantially all the economic benefits from the use of the asset throughout the period of use? That means the customer is going to gain or take the benefit of all the economic benefits from the asset, and that is for throughout the period of use. If the answer is yes, who has the right to direct how and for what purpose the asset is used through the period of use? So this question we need to ask to see that whether the lessor is having the right or the lease is having the right. In few contracts, there may be predetermined conditions, like the customer will give the direction to the lessor on who will be operating the asset and how the asset will be designed. So if the answer is the leasing, the customer is going to direct how and for what purpose the asset is used, or the customer has designed the asset and operates the asset. In that case, the contract contains a lease. So all these four conditions has to be fulfilled to do assessment whether the contract is having a lease or not. So let's take an example to get more clarity to understand how the lease is identified in the contract. An entity enters into a contract to buy all of the electricity produced by a new solar farm for the period of 20 years. The solar farm is explicitly mentioned in the contract and the supplier has no substitution rights. The customer designed the solar farm before it was constructed. The supplier builds the solar farm based on customer specification and afterwards operates and maintains it. There are no decisions to be made about whether, when, and how much electricity the solar farm will produce. Does this agreement contains a lease or is it a sale of power agreement? So let's go one by one. Is there an identified asset? This is very simple. You have a solar farm, so that is an identified asset. Has the customer the right to obtain substantially all the economic benefits from the use of the solar farm? The answer is yes, because the contract says that the lease is going to take all the electricity for 20 years. Has the customer the right to direct the use of the solar farm? This is very clear because the customer has made very clear and it is predetermined. And he has designed the solar farm as well. So he has designed the solar farm. He has agreed that he will be taking all the benefits out of the solar farm for the 20 years time. So the contract contains a lease of a solar farm. It is not a sell deed. Now let's take another example. Customer X enters into a contract with supplier Y to use a vehicle for 5-year contract. The vehicle is identified in the contract. Supplier Y can't substitute another vehicle unless the specified vehicle is not operational. Under the contract, there are few conditions. Customer X operates the vehicles or directs others to operate the vehicle. Customer X decides how to use the vehicle. Customer X decides where the vehicle goes as well as what it is used for. Customer X can also change these decisions throughout the period of use. Supplier Y prohibits certain uses of the vehicle, for example, moving it outside the country, or modification to the vehicle to protect its interest in the asset. Whether customer X has the right to direct the use of the vehicle throughout the period of lease. So in this case, if you see, the customer X has 100% right to use the vehicle and as per his wish. Okay. So vehicle is identified. How the vehicle to be used also has to be decided by the lessee. And the most important part is that the substantial benefit from the asset will be only consumed by the lessee. So in this case, the contract is a lease contract. And because a supplier Y has prohibited to use the vehicle to certain to protect the right on the asset, it will not change the definition of lease. So as we have understood now what is lease term and what is lease in a contract, so let's understand how this lease accounting has to be recognized or measured in the books of the lessee. So at the commencement date, a lessee shall recognize a right of use asset and a lease liability. This is what I discussed in the first slide saying that IND AS has made very clear that in case of lease accounting, the lessee has to account the asset and that asset is named as right of use asset. Okay. How it will be valued, we'll see in upcoming slides. But let's understand first what is a lease liability and how it is measured. So leases shall measure the lease liability at the present value of the lease payments that are not paid at the date of commencement. So on the date of commencement, whatever lease has not been paid to the lessor for the lease term. Okay. So I'm not going to talk about more about what is the meaning of lease term. We have already covered that. So for the lease term, whatever rent the lessee is going to pay, that has to be discounted and we have to find out the present value on the date of accounting. Now question is what is the discount rate we should use? Discount rate should be the interest rate IRR of the lease. Okay. Or if the IRR is not determined, then we can apply the borrowing cost as well. Okay. So your average borrowing rate can be considered for determining the discount rate. Now let's understand what is lease payments. Is it only the rent what we are going to pay to the lessor, or is there some other payment which needs to be part of the lease payment? So the first point is that there are 4 items which need to be considered. Fixed payments. So lease payment should be fixed payment. Variable payments are not considered If there is any variable component in the lease, then that has to be excluded. Only the fixed amount what we are going to pay has to be considered. Any guaranteed residual value expected to be payable by the lessee. That means at the end of the contract, if any guaranteed value has to be paid to the lessor, that has to be considered. Point C, mostly purchase option price. That means if you are deciding to buy the asset in between of the contract or before end of the contract, then you have to consider the purchase value. And the last one is penalties for terminating the contract. If the contract says that the lease is going to pay penalty if it terminates the contract, then that has to be considered. But in the industry, mostly point number A, the fixed payment, and point number B, guaranteed residual value is considered. Now let's take an example where we'll have more clarity about fixed payments and variable payments. Entity T is a telecommunication company that has entered into a lease contract with the entity AS for exclusive use of submarine cable for overseas communication. The contract is for 10 years, which corresponds to the cable's economy life. Okay. The lease payments are dependent on the cable's usage, subject to a ceiling amount of 10 million per year at 100% usage, and an amount of rupees 6 million per year, which corresponds to usage of 60 or lower. So this is the minimum guarantee as per the contract. Management of entity T estimates that the cable's average usage will be 85% and the average annual lease payment are expected to 8.5 million. How would the lease payment be calculated in this case? Okay, so the upper limit is 10 million for 100% usage. The minimum is 6 million for 60% and lower. So you can't be below that. That means at any cost, you have to pay a fixed amount of 6 million. However, the management has estimated that almost in all scenarios, it will be 85%, where the management believe that the lease payment will be 8.5 million. So let's understand what is the amount to be considered for calculating the lease valuation. Annual lease payment of 6 million, which is the amount that entity T is contractually required to pay, should be included while calculating the lease payment. So as we discussed in the previous slide, fixed payment only to be considered. No variable component has to be considered. So in this case, the company is going to account 6 million for lease purpose. So now let's take an example how to determine or how to calculate the lease liability. A company has taken a car for 4-year lease. The company should pay 50,000 rupees for first year, 60,000 rupees for second year, 70,000 rupees for third year, 80,000 rupees for fourth year. As per the agreement, the lessee has guaranteed its residual value of rupees 50,000. It is expected that the value of asset after 4 years would be around rupees 20,000 rupees. Hence, 30,000 is expected to be payable. The fair value of the car at the inception of the lease is 2,25,000 rupees. What is the initial lease liability as per IND AS 116 if lessee internal rate of return is 10%? So if you see in this particular question, the rent payment for each year is very clear: 50,000, 60,000, 70,000, 80,000. The guaranteed residual value, which is amounting to 50,000, as per the question, it is clear that 30,000 has to be payable. Okay. Now let's see how the lease liability has to be calculated. So as per IND AS 116, lease payment includes fixed payment, GRV, and penalties. Okay. How do we are going to calculate the present value? You can see the table here: year 1, year 2, year 3. In all these three cases, you can see the rent 50,000, 60,000, 70,000. As per 10% discount rate, this is the amount what we are going to determine for the present value of future lease payments: 45,450, 49,560, 52,570. And in fourth year, you can see the amount is 1,10,000, which is equal to 80,000 plus 30,000. 80,000 is the rent of fourth year, and 30,000 is the GRV, which is expected to be paid at the end of the fourth year to the lessor. So the lease liability to be recognized here is 2,22,017. So we have understood now what is lease liability. Now let's understand what is right of use assets. So at the commencement date, a lessee shall measure the right of use asset at cost. The cost of right of use asset shall comprise What are the items we are going to add to right of use assets? Initial measurement of the lease liability. So whatever we have determined the lease liability in the previous slide, that is the liability part. What is the correspondent debit? It is right of use assets. Okay, so you will have an asset and you will have a correspondent liability. Second, any initial direct cost incurred by the lessee. Okay. So whatever present value of lease liability you determine in point number A, in addition to that, any initial direct cost which is incurred by the lessee also has to be added to right of use asset. Estimate cost to be incurred by the lessee in dismantling and removing the underlying asset, restoring the site on which it is located, or restoring the underlying asset to the condition required by the terms and conditions of the lease. That means if the lessor and lessee have a contract saying that at the end of the contract, the lessee has to make everything in the same position, in the same way the asset was handed over to the lessee, then the cost what is to be incurred for that has to be added to the right of use assets. Reduce any lease incentive received from lessor, third party. Okay, that means if there is any incentive received from the landlord, from the lessor, or from a third party, then it has to be reduced. Okay, so let's understand what is the initial direct cost. Initial direct cost are incremental cost of obtaining a lease which would not have been incurred if the lease has not been obtained. So cost incurred in negotiating or securing lease agreement, brokerage, legal cost, etc. All these type of cost, if you are incurring before we sign off the lease agreement, those costs are initial cost and has to be added to right of use assets. So let's take an example how to determine the right of use assets and lease liability. Lizzie enters into a 10-year lease of a floor of a building with an option to extend for 5 years. Lease payments are 50,000 per year during the initial term and 55,000 rupees per year during the optional period, all payable at the beginning of the year. Okay. To obtain the lease, Lizzie incurs initial direct cost of rupees 20,000 rupees, of which rupees 15,000 relates to payments towards legal fees, documentation, and rupees 5,000 relates to commission paid to the real estate agent that arranges the lease. As an incentive to lease for entering into the lease, lessor agrees to reimburse to lessee the real estate commission of rupees 5,000 and leases leasehold improvement of rupees 7,000. At the commencement date, Lizzie concludes that it is not reasonable certain to exercise the option to extend the lease and therefore determine that the lease term is 10 years. So it is very clear that the lease term is 10 years. It is not 15 years. The company is not going to extend the contract. Lease's incremental borrowing cost is 5%. So the company has to record the journal entries as on the date of commencement. So let's see how the entries will flow. So as per IND AS 116, at the date of commencement, a lease shall recognize a right of use asset and a lease liability. So what are the lease payments here? Lease payment equal to fixed lease payment plus GRV plus penalties. And in the question, you would have seen that the payment of rent is at the beginning of the year, correct? So in that case, the first installment is paid at the beginning of the year and we don't require to do any discounting for it. So we're going to do discounting only for the remaining 9 payments, that is remaining 9 years. Okay. So what is the amount we are going to calculate here is 50,000 into 7.1078. That is after discounting it at the rate of 5%. The amount is now 3,55,391. So this is the lease liability, 3,55,391. What is the journal entry we are going to post now? So if you see here, lease liability we are creating for 3,55,391. But the RU asset what we are going to capitalize is 4,05,391, which includes 50,000 rupees of cash which we paid rent at the beginning of the year. In addition to this, there is also a initial direct cost incurred by the lessee. Okay, so we have to add that to right of use asset. But if there is any incentive from the lessor, then that has to be reduced. So the initial direct cost incurred by the company is 20,000 rupees. Less incentive received is 5,000. So the net amount of 15,000 has to be added to right of use asset. Here, if you see in the question, there are two type of incentives given by the lessor: 5,000 towards the reimbursement of the legal cost and 7,000 incentive for leasehold improvement. So the 7,000 we are not going to adjust here. The 7,000 is towards leasehold improvement, which will be taken care when we capitalize the leasehold improvement. So at the time of capitalization, we have to reduce by 7,000 rupees. So 7,000 rupees is not connected to RU asset, hence we need not do that. So once the lease liability is calculated, we determine 3,55,391. So this is recorded as the opening lease liability. On the other side, RU asset, it was 4,20,391. This is the opening RU asset. Okay. This is the entry we posted: 4,20,391 debited to 3,55,391 to cash 50,000. So this 3,55,391, every year there will be an interest cost of 5%, and then payment to lessor is 50,000, and then we have a closing balance. From the lease side, every year the cost what is going to profit and loss account will be these numbers, the interest cost year by year. Okay. On the other side, from the RU asset, the amount of depreciation calculated for the year will be part of the P&L account. So from the P&L side, if you see for the first year, 42,391 plus 17,770 will be part of your P&L account. Okay. Rest remaining all are your balance sheet items at the time of reporting or at the time of year end. Okay. And every year the percentage will be calculated at the closing balance. And in case of depreciation, it is fixed rate straight line method. If the company follows WDB, they can follow WDB, but most of the company they follow straight line method, so that by end of the contract period the amount is nil, the RU still value is nil. Now, how do we know that the calculations are correct? Okay, so if you see in the initial period the cost is higher than the rent paid to the lessor. Okay, so this works similarly like loan taken for any other purpose. So if you take a loan from bank, the interest payout in the initial year is higher compared to the interest you pay at the end of the contract. So similarly here also the interest payment will be higher in the initial years. So to check whether your working is correct or not, the total interest plus depreciation. So the total interest amount 94,609 plus your depreciation 4,20,000 rupees equals to the 5 lakh rupees what you have to pay for 10 years rent plus 15,000 rupees towards the initial direct cost. Okay, so this gives a proof that your both calculations are correct. Now let's see what is the journal entry we are going to post as an example for first year. Interest expense to lease liability. So if you see here, the lease liability determined was 3,55,391. So we have to increase the lease liability hitting to the profit and loss account. Interest expense 17,770 to lease liability 17,770, and then release the payment to the lessor. Lease liability 50,000 to lessor 50,000. Okay. Coming to the asset side, RU asset movement for the first year, depreciation to RU assets. That is 42,039 to 42,039. So this is our last slide where we will discuss about the treatment of RU depreciation and interest cost under Income Tax Act. So both RU depreciation and interest expense are not allowed under Income Tax Act. That means you can't claim this cost. Only the lease payments made to the lessor is allowed as deductible expenses. So whatever you have paid, like in the previous example, we talked about 50,000 rupees. The 50,000 rupees what you have paid has to be considered for deduction. The interest expenses and the RU depreciation will be excluded. That means it is not allowed. The difference between the RU asset and lease liability at the year end will be considered for calculating deferred tax asset and liability. Okay, because it is a moment from beginning to year end. So the moment, if any, has happened and the difference between RU asset and lease liability, then that has to be considered for deferred tax asset. Considering the previous example, below are the impacts under Income Tax Act. Year one, you see depreciation was 42,039, interest was 17,770. So total expense allowed is 59,809. What amount to be claimed? You can claim 50,000 rent what you have paid, and you can also claim the 15,000 rupees what you pay towards the legal cost, the direct expenses. Deferred tax calculation, RU asset as on 31st March was 3,78,352. Lease liability as on 31st March was 3,23,161. So the difference of 55,191. So you have to create a deferred tax liability of 16,557. Okay. So that's the end for this session. We'll have part 2 where we'll discuss majorly on the lesser side as well as how it will be accounted by manufacturer and dealers if they make any sale under lease model. Thank you.